Hello, this is Shimerja. Today is March 27th, 2017, and this is Capital Discussions Monday Market Muse. Before we get started, as always, a quick disclaimer. Capital Discussions is not a broker-dealer investment advisor. This presentation is for educational purposes only. We have no way of knowing your situation and no way of knowing whether what level of risk is appropriate for you. The risk of trading options can be substantial. Please be aware of all risks before making any trades. Any trades that we talk about are computer simulated, are believed to be accurate. However, due to such factors as liquidity, slippage, and commissions, your results will end up varying. Okay, let's go and take a look. Basically, this was just a couple of things that I was looking at. Let me go and take my first chart. I want to end up taking a look at the bigger picture before we end up drilling down. And just attaching that one. And Paul, I also promoted you if you're there. Okay. A couple of things. Let's get and dive right into where we are here. The challenge that I had mentioned is that it looked that when we had this breakaway gap that we were going to end up having at least somewhat of a pullback to the trend lines where we were. The support really looked to be close to 2350. The challenge I see here, the biggest issue, is that we've made a lower low. Okay, you can see that here and now today, and we've made a lower high. And so we're starting to end up forming a downward channel. This is a bit of a challenge, especially here, because when you climb this quickly like we did in early to mid-February, we don't have any good price level supports that I could end up drawing. The best I could end up doing is drawing some channels. We've broken through all of our channels. I will have to end up going back and taking a look and seeing if there's a better channel to end up drawing here, but there really isn't anything that's great. If I end up showing you this one, and I think it was basic too. What I ended up drawing here, where I wanted to end up drawing some longer term channel, and this was the channel that we had broken out. And if you remember, a few weeks ago, we were talking about a blow off top, and that was, we were already above a long term trend line, and we ended up having this gap up. And that was actually the high that we've had. We just broke 2400. We haven't been able to end up getting there back since. Here's what I wanted to end up pointing out. I had pointed this out a couple times before. It is rare that you end up getting this clean of a channel, both on the upside and the downside. When you get this clean of a channel, it tends to end up meaning that it's more it's probably going to end up being a little bit stronger and holding a little bit better. You can end up seeing the multiple points. If I end up even going back from the very beginning of the year where we started, you can end up seeing, we touched, if you want, here, 1, 2, 3. We were here multiple times. If we were here for almost a month, pushing up against the top of the trend line, we came up, touched it again here in December. Tried to end up getting towards it in January, and we finally broke through it in mid-February. When we broke through it with a vengeance. We moved up very high, and then even after we broke through it, we had another big gap higher, and this was the blow-off top. We've since come back into the channel, which is a good thing in terms of support. The challenge that I end up having here is that the center line, this green line, when I hold my cursor over here, that's a 20-day moving average. The 20-day moving average is actually sloping from upper left to lower right here. This is the first downward slope that we've had in the 20-day moving average since going into the elections. Okay, and so that's not a positive. Not just breaking the 20-day, and you can see that the 20 days acted as support for a long time. Once we ended up breaking it, not only did we break that, but now if you take a look at this orange line was a 50-day. Okay, and these are the simple moving averages, not the exponential. Well, today we actually broke the 50-day, and unless we can get on top of it, it will end up going from being resistance, or I'm sorry, for going from support to resistance. So I'm kind of worried right here, and I don't see a lot of good things below us at this point. Okay. I did ended up drawing, and I don't think I may have showed you this. I think I did this for a another one. I drew it on the SPY, and I did this a couple of weeks ago when we were talking about our blow off top, and we ended up coming back. And you can see here, right, same trend line, just in the SPY, right? Everything looks the same. But if I just highlight this here, um, this line was drawn on the 13th. Okay, and what I ended up seeing was the scary part on the 13th was that we weren't seeming to move higher. Okay, usually on all of our pullbacks, we had tried a few days and we'd bounce back up. Here we weren't bouncing back up. We finally did, but the problem was that we spent too much time here, and when we ended up bouncing, we didn't bounce enough. You can see I did not draw this. Okay, granted, I drew this, like I said, on the 13th, so almost 2 weeks ago at this point. And then I thought that if we end up getting the lower high and a lower low, it would end up being, not a good recipe for moving forward. Uh, Trends, we're still in the trend. We're still in the top. One of the things that I did want to end up showing on the previous graph was I end up liking to use some channels. Let me go back to where I was on the channels. Basic two. And I had been showing you different types of channels. Here I want to end up showing you Keltners. Okay, Keltner channels compared to a lot of other things, and we'll end up reviewing others in a minute, but I want to just focus on Keltners. They use 20 like many other channels do, but they tend to end up being narrower. If you see the upper line of the Keltners, the dotted pink line, the lower Keltner is the dotted blue line. They tend to end up being narrower. They don't get as wide or as narrow as something like a Bollinger Band, for example. And so when we ended up breaking above this, one of the things that you sometimes worry about is that when you get too far away from the 20-day, you tend to end up coming back with a lot of velocity, and that's what we did. We came back, and you see we held it, and it looked absolutely great for a few days. But then when we ended up breaking it on the 21st, we got through, and we got all the way through the bottom Keltner. And what will end up happening a lot of times with the Keltners, as with other channels, you'll tend to end up riding them. In the Keltner, it's very common to end up riding either just on top, okay, or just below the actual channel when you're trending. Okay, that's usually a sign that we're trending, and you can see that we rode the top here for a while. We rode the well above the top, and so now we're below the Keltner. And if you take a look at every time we've been below the Keltner, if we just don't pierce it for a day or two or three, okay, for a small period of time and bounce it back up, if we do start to end up selling off, you can end up seeing here what happened in January of 2016, that we wrote it down for quite a bit once we did. I wanted to point out that we broke the bottom of the Keltner. We broke the 50-day moving average. We've come back in. So all of these things are not very positive for the market. If we take a look at the oscillators, okay. If you remember, I look at about 6 different oscillators. I list them from the slowest to the fastest, the slowest oscillator being the MACD. Over here, you can see, by the way, these are exponential moving averages. We broke the 50 exponential also. Let me just highlight this part of the year so we can end up seeing this a little bit better. Okay. So you can end up seeing that everything is turned negative. We tried the fast-moving oscillators, things like CCI and William Percent R. They sold off. They tried to end up bouncing, but with today's sell-off, we're back in the basement. Okay, we're back on this one. Now, some people will end up saying, "Oh, we're oversold," and we could be, but at this point, the market has a tendency to end up moving much, much quicker at this point. I know that the VIX doesn't appear that it's moved all that much. We're up 1.3 on the VIX. That's about 10%, and we're up to about 14 and a quarter right now. But if we bounce back up, calm will be restored, everything will end up being fine. But if we continue to end up getting any type of sharp movements, we could be in for a roller coaster ride. And so this is probably the single biggest, you know, fear item, okay, that we've had since the election. And in some ways, um, it was, the fear was what happens if the Republicans end up winning. That happened. We really didn't have a sell off. We bounced. The big fear item before that was Brexit. What happens if the UK votes to leave the European Union? They did. They sold off somewhat. We sold off for a few days, and we bounced back up. This is one that concerns me more because the run up that we've had basically been since the election, since the U.S. election, since you know, um, right here, there's been I'll call it a honeymoon period with the market. That the markets decided that they really like to end up seeing mostly, tax cuts and a lot of infrastructure spending that would end up helping the economy and going. That those are things that are very, very good for the market. The Republicans not being able to end up passing, okay, their version of Obamacare in the House, even though it was going to have problems in the Senate. This was supposed to be where they were supposed to be able to end up getting it through. It's starting, it could shake confidence. Now, we're going to be in a news, and I mentioned this on Friday, we're going to be in a news-driven cycle at this point. When things become good, they'll become very good, and we'll end up being back on. But then what ends up happening is that, and you don't know if this was the catalyst, but you start to end up getting a bunch of other news that can end up having an effect on the market that might even be more impactful in the sense of its real influence over the market. The Chinese government said that they were not going to end up participating in repo markets anymore. This has to end up doing, and I won't go through the whole thing and bore you guys to death with it, but it basically has to end up doing with interest rates. And so, if the Chinese are not buying bonds, and buying bonds, okay, pushes yields, right? Pushes when they're buying. Hey, Paul.
Hey, how are you? Excuse
Good.
me. Just to clarify, that was for this morning.
Yeah, thank you. And Paul, you had read a lot about on this. Why don't you comment a little bit on, what you've seen, okay, and what you've heard, and how the markets reacted, okay, to this announcement by the Chinese early this morning?
Well, it came out not long after our markets opened, and I read that they decided not to participate in the repo market today, which was overnight for them. And the markets just kept going down. And the currencies just started getting beaten up. The dollar was off. And, you look and the 6E is up, 0.75%, which is currency. That's a pretty big move. So, this is, I am a big proponent of the markets driven by liquidity.
Mm-hmm.
And so that they're sucking liquidity out of the currency market, it gets sucked out of everywhere. Or the fear is that it will leave.
It's a big challenge. I think it's a real big challenge to where six. You know what? I'm doing everything backwards here. I'm just trying to end up pulling up some of the currencies. And you know what? Let me do this. Let me just attach it, and I'll just bring it over here. Let me try to get it. Okay, the 6E. Okay, that Paul. For those of you who don't trade futures, he was referring to the U.S. Dollar. Let me get rid of all of these studies because we don't want to see all of this crap here.
Yeah, the 6E is the straight euro.
Okay. So you can end up seeing here that when there was thought that interest rates were going to end up rising, and we went through the Fed meeting, okay, interest rates rising usually makes your currency get stronger, okay, and that's what ended up happening. And Here's what Paul is talking about today. Okay. Normally, right? Normally, when the market is selling off like this, it would be a signal to the Fed that, ooh, the market is already cooling off. Our interest rate increases that we've done, the two of them are working. We can stand back. Usually, the market ends up taking that as a positive sign. But with this going on, there is the strong possibility that interest rates will move up faster, and hence there's more demand going into the U.S. dollar. You can see this from the euro. You can end up seeing this from um, the British pound. The same thing happened with the British pound, and the same thing happened with the Japanese yen. Now remember, this is when we're looking at futures. By the way, everything looks the same. If you're an FX trader and you look at the exchange rate, because the pairs are the opposite on the yen, this would be a sell-off in the FX market. The way it would
Right.
end up looking, because
Yeah, look at the USD JPY.
okay, USD JPY. Now this is the actual currency, and you'll see it's just a mirror image, okay, of it selling off. Okay. The other one that I always end up taking a look at, because this one is the um, USD. Oh, I did that backwards, didn't I? How come it's not letting me? Okay, there we go.
Toss is a little screwed up today.
Yeah, I mean it's usually slow getting me my grasp, but not slow letting me type.
Well, it's rejecting orders for me that are perfectly fine.
Okay. And you can end up seeing here now. Now this is interesting, right? Because here, okay, what ends up happening when you're looking at the Swiss franc, um, you know, it's the same type of thing, right? Right. We have a larger movement than you would end up expecting here, and so and this is basically considered to be the world's safest currency. When I end up taking a look, you can also end up seeing what's happening with gold. Okay. Uh, Gold again ends up being priced here in dollars. Okay. The dollar, okay, getting stronger means that the price of gold will get stronger. It also means that if interest rates are starting to end up moving, will we start to end up moving higher on gold? Um, you know, it's kind of early, in my opinion, to end up saying, oh, the economy is going to end up slowing up because of any of this. But what tends to end up happening, and Paul and I, we spoke this morning. I've often said, I know that they say that there's no guarantees on Wall Street, but if there was one guarantee on Wall Street, it's that they're going to overreact, both to the positive side on good news and to the negative side on bad news. And so when we take a look what's happened with the SPY over this period of time, we have definitely ended up having this huge move up. Was this movement overdone? Yeah, probably. Did we need to have this extra blow off top after we had run up so much? Probably ended up being, the market getting in front of itself. Can we end up getting back to this area
Yeah.
in here, which, is the 20, I'm going to call it 2225 area. Yeah, I mean, that's where I see the next real level of support, um, you know, another 10 I'm sorry, another 5 SPY points or 50 SPX points. Let me put up SPX because I know most of you guys talk SPX. It's the same thing. It's just you have to add another zero. Okay. So, if we end up taking a look in this, 22, 2275 area, to me, that's where I see the next major level of support. Um, and I think that unless we can find footing and bounce, and we definitely need to find footing and bounce, um, we'll continue to end up, okay, selling off. Now, here's where, if you guys haven't watched the tape reading, okay, skills, Monday Market Muse that we did a couple of weeks ago, I'd end up going back and definitely taking a look at that. Paul, before I was going to just show the 1 minute. Anything else that you're looking at that you think is important to end up sharing?
No, I think that that is what I'm looking at for support. And remember that, like overshooting on the upside, it tends to overshoot on the downside. So probably that bottom candle in that channel might be more realistic, as a touch. If we are truly selling off.
Yeah.
It's hard to tell with this market.
It is. It's very tough to tell with this market. So if I look here, looking at maybe 2230 area, if we end up going to the highs that we ended up making in November, okay, we're looking at 2210, 2215 area. Okay, that's quite a drop. That's quite a drop.
Maybe the skews will get normal.
Maybe. Let me go through one of the things that I had seen here, Paul, because I wanted to end up actually talking about that. And I have this one here. Okay, here's what you're looking at. Let's first make this real small. Get the volume to be real small also. Okay. What you're looking at here is I put in the price, okay, which is the green and the red. Okay. What you're looking at here is a weekly chart going back to the beginning of time for futures. That's the VX futures, front month futures, and they're in the red and green line on a weekly basis. Up weeks are green, down weeks are red. What you're looking at in the yellow line is the front month futures. Okay, I wanted you to see a couple of things from here. Number one, okay, we hit basically a decade low in the VIX. Okay, recently. Okay, when I take a look at the VIX futures, okay, and over here, one little exception, okay, back in 2014, we also hit a decade low in the futures recently. I just want to end up highlighting what's happened during the week. You've seen that the VIX futures tend to end up moving up much higher. And let's do this. And this is not the actual one. So what I need to end up doing is getting the price. Let me not view this as percentages. Did that not take? Was I too quick? I think I was. Okay, it was a little bit slower. There we go. Okay. What you can end up seeing here is that when I take a look at the VIX futures is normally above the actual VIX. Now, one of the things that will end up happening, and I'll show you this, it tends to end up being a little bit confusing sometimes in and around expiration. But if I make this a little bit larger here, what I want you to end up seeing, and I made that too large, but over the last several years, there have only been a couple of times when the VIX, okay, in the yellow line has gotten above, okay, the futures. And usually it's things like the U.S. election, Brexit, or even probably one of the hardest sell-offs we had after January was in September. We had those few days in September. This is on a weekly basis. Let me show it to you on a daily basis. I wanted you to see the long-term viewpoint first. Okay. And you can see what's happened here over the last week or so is that we went from you know, basically panacea. No worries about anything. We're going to end up getting spending increases. We're going to get tax cuts. Everybody's running fat, dumb, and happy. The market's running up. We basically have had these numbers come down very nicely to decade lows that we ended up having since the election. What I ended up measuring, and there's a lot of noise in this number, so I don't use this number very often. Okay, but I do want to end up keeping the volume because let me just get this over here a sec. It's really slow today. Okay, what you're looking at here in this line, okay, is you're looking at the front month VIX futures, right, minus the actual spot price of the VIX. Okay, so when the VIX is higher than the actual VIX futures, it's not truly backwardation in the sense of contango and backwardation, but it does mean that between now, when this point happens, between now and whenever the VIX futures settlement date is, that they do have to come back together. And normally, most cases, and you can see this, let me show you this going back a long period of time, is with very few exceptions do we end up having any type of pullbacks where the VIX gets to be higher than the VIX futures. Okay. By the way, if I go back to a 20-year, I have to do it this way, a 20-year weekly chart, so you can see the whole thing. Okay. I want you to look at this point here. Okay. I know a lot of you guys had a very, very hard time, okay, with what ended up happening in August of 2015. But you can end up taking a look at just how far that went. I mean, the fact that when we seem to have crises, whether it's debt crises, whether it's the crisis that we ended up having where we thought that we might not be able to actually end up paying the U.S. This was the debt crisis that we ended up having in terms of the U.S. not passing the extension to the debt limit. You can see this was the market low, okay, or pretty close to the market low that we ended up having. Okay, and just how ugly things had gone. This was during 2008. This was, if you guys didn't trade this period, boy, you missed a lot, right, Paul? It's that exciting time that was. And so, what's happened here when I came back to the week or the daily chart, right? We did have a day that broke underneath. Okay, that broke underneath. And let's just highlight since the election. Yes, you were below it on the election, and this was the first time that we ended up actually getting below. Okay, and you can see what ended up happening here. This is when we started to end up moving up. We're also getting very close again. So if the VIX gets above the VIX futures, that's when you start to have I don't want to call it panic, but you get people who are very, very concerned. Okay, so I wanted to point that out to you. Different than the VIX futures being in contango when you talk about, Vol Vantage or any of those trades. This one definitely has an impact on the price, but it probably has more to end up doing with the overall price moving up and down on something like the VXX or the UVXY or the XIV, depending on which ones you end up using. But there's definitely some concerns out here at this point. Paul, I don't see. Okay, there are a couple of questions here. Okay. Yeah, I wasn't close to the mic in the beginning. I realized I didn't have it in front of my face. Sorry about that. The 2280 is where all the volume is. When we take a look this is one of the charts that I end up using, so you guys can end up seeing.
I'm pulling up my investor RT to check.
Okay. Yeah, I don't have it. It's a longer term chart. So pull that up. Um, the comparison between the VIX futures and the VIX is not very appropriate, as the VIX front month depends on days to expiration. Very, very, very true. Okay. Here's why when I look at Volvantage, I definitely take consideration into where the market is. The reason why I ended up showing this, if you end up taking a look at the green and the red lines here, the green lines are the VIX futures. Okay. The VIX futures expiration. And on this day, right, on this day is basically when they actually go out in the front month. Now, what ends up happening is that the VIX changes from being the front month to the second month on that point. So they never actually touch and then end up moving. But yes, if there's one day left, like right over here, okay, and they're not closer, that's a much bigger deal than if you're a couple of points higher over here. So one of the things I take a look at is that it also makes a big deal, okay, believe it or not, whether or not the VIX futures end up expiring in front of or after the regular futures. So I'm sorry, the regular S&P 500 and all of the options, the equity options. So what ends up happening is that every third month, okay, which is the last month of the quarter, you'll end up having the VIX futures end up going through. And so one of the things that I discarded when this happened, okay, was that it was exactly that, right? We were coming up to the VIX futures. Now, yes, it happened 2 days before the roll, and on the roll we were still low. And the reason why I decided to show this to you this morning, and it is appropriate, is that now we have whatever it is, 25 days, 26 days left to go to expiration on the VIX futures, and we're again very, very low. And when you end up taking a look at this, I will take a look at whether we're 1 week, okay, to expiration, whether we're 2 weeks to expiration, and without question, in the last week you kind of have to discard things. This was not something that you would discard. Why? Because the thing is, you can end up seeing right in here, it was in the middle of the expiration cycles, and this was the election. That was a real fear. If we come down here again at this point, with this much time left to go, if you take a look right after the green lines, right up here, we're pretty high. If you look up here, we're pretty high. If you look up here, we're pretty high. If you look up here, we're pretty high. We're pretty high usually right after the green lines all of the time. Here, we're right after the green line being the VIX expiration, and we're starting to sell off. This is the lowest point that we've been in a while. Okay. If I end up showing you this graph, okay, let me come over to here. Paul, I'll show this one graph. Are you ready to go after I show this one other one?
Yes.
Okay, let me get rid of this. And let me get one more comparison here. And this one doesn't take, it does it to a degree, but.
You can take your time.
All right. If I end up showing you, and I can't do this here on an ongoing basis, but what I can do, let me pull this over to here. Let me select this. And on this one, what we're going to look is that we're going to look at the current month, okay, because March is expired. You can see that right here, right? You can, for those of you that can't end up reading it, it says VXJ7, okay, and that's what we just started, okay, because H7 was March, J7 is April. So if I take a look and I end up doing the futures of basically the contango roll, which is VX, okay, I'm going to end up taking a look and saying it's M7, right? M7 means M is for June minus, okay, VX K7, K is for May. Okay, and I take a look at that. Oh, I didn't. I'm an idiot. Hang on. I had an extra slash in there. You see that extra slash right there? It is slash slash. That's why it's not working. Okay. So when I end up taking a look at where we are at this point, okay, this is something that tends to end up increasing as you get closer to expiration. Okay. Um, you get closer to expiration, and here, let me show you this. Maybe it's easier to see it on VIX Central. Um, as you get closer, what tends to end up happening is that your front months tend to end up coming down more. Okay, so you get more of a curve where it's steeper going left to right. It's a steeper curve, and then as you go further out in time, it gets flatter. Okay, this line became relatively straight last week, and now you can see it's actually starting to become less steep. Okay, we're still in contango, right? We're still in contango between these two numbers, and you can see that the difference, okay, between the two numbers is the second future, meaning the May future, is still 0.23 points more than the front month future, which is the April future. And if you look at it, if you measure in percentages, 1.6%. So we're still in contango, but we're in a lower level of contango that we have been for some time. Okay, this is usually a sign, and that started to happen on the big sell-off day that we had early last week. It started to end up shrinking, and it has continued to shrink as we've sold off here. And so, to me, this is another sign of things getting a little bit worrisome. Now, one of the things that's happened is that um, the the volume that ends up moving in different areas is driven so much by computer-based trading that it's going to end up changing the shapes of what we used to see in this contango curve. It's going to end up changing what we used to end up seeing in how steep put skews were because of the high frequency trading guys have moved into the options world over the last several years. Now, that's not necessarily a bad thing if you know how they trade. And this is truly, you guys probably have heard me say this. This is a game of whack a mole where if the high frequency algo guys go after one strategy because it's a nice fat juicy premium, or they think that they can end up having a huge advantage trading one thing, they can take whatever advantage we may have had, okay, when we had traded this longer term away. But by taking that one advantage away in one place, almost by definition, they can't make every advantage go away every place. Something else pops up. And taking a look at this, like for example, okay, I'll give you one example. I would not use the midterm, okay, VIX-based ETFs and ETNs normally, because we normally have much better separation in the first 2 months than we do between months 3 and 4. Okay, and that's what they'll use 3, 4, 5, and 6. Okay, and so what I would end up doing at this point is not touching either one of them. However, once this thing starts to end up moving, I will be taking a look at the midterm ones to see if ZIV, okay, the midterm VIX-based ETF, would end up being a better trade than the XIV. Right now, we can't be in either one of them. We're kind of in no man's land. Okay, I'd rather have things settle, end up moving, have it either continue to sell off harder or find footing, have IVs come out, and then get in. I know I'll be in later, but I really don't care. I'm much more concerned, okay, in these strategies. For any of you who've looked at these things, and you've tried to follow any of the VIX-based strategies that use the ETFs or ETNs, drawdowns were absolutely a killer for most people, right? An absolute killer. And what I had decided to end up doing was not rush in and get in the trades all the time, but let things get established and then end up moving in. And right now, what we end up seeing here is just, it's concerning to me at this point. Paul, while I have the ball, before I give it to you, I'm going to end up showing one last thing, and that is how skew has changed visually. Okay. So if we end up taking a look at how skew's changed, and let me stop this here, and I'll go day by day. Okay. One of the things you can end up seeing here is this is 10% up, 10% down. I'm only looking at options over 25 cents on the SPX, and I'm only looking at the April monthly and the May monthly. Okay, this way it takes away a lot of the noise. Paul and I tend to end up calling this the belly of the curve. What ends up happening is that IVs above the money settle down until they get so cheap that they actually go up a little bit. If you take a look at the pricing here, that's because a nickel changing something 95 cents by $1.50 is a big deal compared to say over here where a nickel on $27 doesn't mean very much. So this is kind of like, I don't want to call it a false line here, but it tends to end up really pushing IVs down, 3, 4, 5, 6% below the money, and they tend to end up falling quite a bit there. And one of the challenges we end up having is they're going to end up driving that down. What are they doing with the rest of the curve? Now, I'd also take a look and see where we are, and you know that at the center. Okay, our IVs have been in the 11, 12 area. Above the money, okay, we've been in this, you know, uh, 7, 8 area. Maybe a little bit higher, 9 area. So if I end up coming through and I start to end up going day by day over the last month, and you can see the day changing here, and you can see that we started around 17. We've already started to end up moving up, and as we end up getting closer, look at what's happening now. We do get steeper in the front month. I'm not saying it's not, it's normal, but not this much. Not that the back month here is higher than where we had started. And then once we end up getting to some of the sell-off stuff that we ended up having, you can see how steep that the put skews have gotten. And so this has made trading a little bit more challenging to see where we are and what's going to end up happening. This is now what drives put skew higher. Okay, what drives put skew higher? Everybody will end up telling you it is the fact that if IVs move, people are more afraid not of a 2% pullback, but they just need their protection because they've made so much money. They really need to buy something at 5 or 10%. Okay, if the market really sells off, that's when they're going to be concerned. Let me give you another trade that will actually end up, okay, if you do them big enough, will actually end up making put skews get steeper. And that is selling put verticals. Okay, in the selling a put vertical, think what you do if you do like a 25-point wide put vertical. You sell the closer to the money and you buy the back money. Now, if enough people are selling put verticals all along this axis, they're going to push down the closer to the money and push up the further away from the money. Now, two things end up happening. When IVs go up a lot, you get more for a put vertical, which means that there's more likely for people to end up selling it, right? That's fact number one. Number two, high-frequency traders, okay, with their computer-based programs, make money on market moves, right? They need markets to move to make money. Now, once they start to end up getting movement, if the markets start to end up selling off very hard, that's usually a great thing for them because they're going to get movement and they're going to end up making money on their trading. Now, they could get caught, if they're not quick enough and all of that. So one of the ways they can end up helping themselves is to sell put verticals. IV's higher, so they're collecting more. They'll usually end up making money if the markets move down very hard on their high frequency trading programs. So that means that if things start to settle out, they'll make more money by selling the verticals. Where will they sell them? All along the line. If you end up having massive amounts of put verticals being sold on this line, it will end up making put skew steeper. Okay, I've seen evidence of this type of trading. And so one of the things that we have to end up adjusting, and I'm doing this in my Kevlar. People who don't end up realizing that we're kind of gone through this change, and it's not something that just happened. It's something that you probably heard a lot of people complain last year that some of their trading strategies weren't working anymore. This was part of the reason, is that the steepness of the put skew wasn't acting the same way as it was 5 years ago. Okay, so it becomes absolutely critical. Okay, if you plan on being consistently profitable, you understand what's happening in the market underneath your feet. Okay, and this is a trend that's been going on for a while, and we've seen that when the markets sell off, that the put skews haven't gotten flat the way they used to, not nearly as much. And so what I'll do is that I'll show you a trade that I ended up putting on Friday, but we'll save that for the end. Paul, do you want to end up talking a little bit about volume and some of the indicators that you're looking at? Let me give you the ball.
Yeah, I can just show the graph. It shows the volume, on this program, which I think is much more accurate than TOS.
You have the ball, Paul, now?
Nope, not yet. You're still sharing your screen.
Oh, do I have to stop sharing before I give you the ball?
I think you could just move the ball to my name.
That's what I thought. That's what I was trying to do. Okay, there we go.
So I've showed this software before. I find it's much more accurate representation of the volume profiling than what TOS gives. So this is a daily chart, and so in between is, I have each day has, I think it's each week has its own little volume profile. But excuse me, looking at the bigger picture, this is from, I believe, 2013 volume. But what I did is I drew a volume profile from, let's see, it's July 11th, going forward until today. So this gives us a better picture of what's happened in the interim. So we have this section of time here and then the run-up. So what I'm looking at is, this upper high volume node is actually somewhere around 266, 267, where it starts. And then the big node, the most volume traded during this time frame, is right here, where this red bar is, down at basically 2149. So this is where the most ES contracts have traded. And you can see we're up in this area here. So, we've got a lot of, this is very thinly traded until you get down into here, 2292. So this will move around a lot. They're trying to figure out if there's any price acceptance in this area now. see if I can move this out to here. Okay, that's better. So there's where we bounced up to the top, and we had some volume here. So now it's trading. It's going to trade between here and here. So that's it.
And so if you kind of end up taking a look at,
I can't hear you.
sorry, I moved my microphone away from my face again. If you end up taking a look at this, how do you end up reading when I take a look at it, I'm seeing from, let's call it late 2016 through the end of February 2017, we were in that sideways channel for a long time, and so I would assume that the time has a lot to do with that mound that you have on the right hand side that's in that 2275 area, 2260 area.
So
is that a fair way of looking at it, or
these bars are created solely based on how many contracts were traded between this time and the present. So I can make this chart, let's see if I can move it this way. Yeah. So like if I take and just do the run up. So now it's just taking the amount of contracts per contract, because this actually does ticks. So we're seeing each contract traded now from between July. Right. 4, 3, November 7th till today. So I set what time frame I want to look at these.
okay?
So if I take and screw this graph all up and go 5 minute, so there's today, there's Friday. These are looking at 5 minute bars, so now we get the volume bars for the 5 minute. And there's the daily bars, going back to the beginning.
Okay.
So I think I have it started at 10/18 of 2013. So you can see even, of course we keep going up, we keep making new nodes, so these are all fairly recent nodes. And this is the most popular spot since 2000, the beginning of the data.
Yeah. So it definitely is a function of time to a degree, but it's really the volume, right? Because if you're not moving and you're not trading, but you're there for 3 months, obviously the volume will build up.
Correct.
And so, do you take a look at this on shorter time frames? Does that make sense for you to end up taking a look at it, say, starting from mid-February, once we started to end up moving? Because at that point, we had big movements up and down.
Right. It depends on what I'm doing. If I'm trying to scalp the ES, this is set on either a 1 minute or a 2 tick Renko chart, which the bars are changing every 2 ticks. Actually, the bars change after it goes above the top tick. So I'm watching very, very short time frames when I'm trading that, or when I'm looking at having to make an adjustment. I want to see where these nodes are. I want to see where the probabilities of the price stopping. So if we're heading down and we're heading into an accepted area, it'll reject the low areas and then move to higher areas most of the time. So if I'm in here, I'm expecting that the market's going to move one way or another. When I get up here, it's an area where I think it'll stop. So it just helps me make a judgment, making adjustments or putting trades on or taking them off.
Okay.
But I use this to give a bigger picture of, where I see the support and resistance could be, will be, but could be. That's why I said this looks like a really good spot. Because after this, it's down in here. And this is pretty choppy, so figuring it out, I'd say probably 2150-ish in the ES would be the next area if it goes through here.
Okay. Anybody have any question on that? Because, this is a great tool. And, a lot of times it ends up giving you a feeling for where a lot of people have ended up establishing their positions. So I think
there was a couple of questions. Somebody asked me, is this volume analysis on the ESM7? And right now it is. It does take into account the historic data for the ES because it actually combines it all, recalculates it to when the contracts expire. You get the price differences.
Yes.
Between the contracts. Well, this all the historic software from the data from this company, they already recalculate it to smooth it out, so you don't have the big jumps in the.
Got it. Okay, so they do that in the price. Are they also taking the volume from the front month contract on an ongoing basis, or they take just the M7 or?
Just the M7.
Okay.
Now I can switch it over to the following month. I can put in whatever. If it's trading, I can set it up. So I can actually, if the next month out on the ES is trading, I can put that on the chart.
Okay.
But it is reading right now the M7 in the front, and it's reading all the historic stuff from the ES combined in the back.
I'm getting asked. It's a little bit different question from here, but I'm getting asked about buying a 16 delta back ratio.
And one more comment, then I'll be quiet.
No. And then please make your comment, and also I would like your thoughts on the back ratios also.
Someone asked what the software I'm using. It's called Investor/RT. You look it up. The software does a lot of things besides profiling. It's a regular charting program that has its coding language. You can use this with Apple or with any stock. It doesn't have to be just for futures. Really pretty powerful setup. And it's very dynamic. I watch a zigzag chart that is dynamically run forward, calculates what the computer thinks the market's going to do to build its zigzags. It's really pretty cool.
Okay. But I just lost my questions when I started to share again. Paul, if you see the questions, please just take the next question.
Whoever it is must have sent it.
Sent it just to me. Okay, got it. Okay. Hang on, and I'm pulling it up. Okay. Question about a back ratio. Taking a look at a back ratio. The problem that I have with standard back ratios, okay, is that if you're looking and you make up some rule in a back test, I'm going to start it here, I'm going to end it there, okay? What ends up happening is that if you get your timing perfect, okay, it's hard to beat a back ratio. Back ratios will give you fantastic, and I do mean absolutely fantastic returns when it comes to what your actual trade will end up looking like if you can end up getting in at the right time and out at the right time. The problem is that, I remember I told you there was one guarantee on Wall Street. There's actually another one, okay? It's you're never going to have the exact same time. I end up making a joke that if you put a butterfly on and leave it it's just standing there, the chances of you closing at the exact peak of that butterfly are about the same as you winning the Powerball lottery and on your way to cashing in your ticket getting hit by lightning. Okay. The chances of you getting in and out at exact right times of a back ratio are similar. Let me end up showing you just a couple of things here on, if I try to take a look at a back ratio. Okay. It's just a butterfly that I was testing with somebody. And we'll take a look at May, and I'm going to be buying a back ratio. Okay. By the way, your timing in a back ratio means that you put it on today, and the market drops this afternoon. Okay, that's perfect timing. Okay, and so if I do something like this, and where's my 18 delta is, I'm going to end up going along the 2015. 2215. Right, is that delta? Yeah, it's close enough. 2210, let's go to. And I don't know how many points you want in this back ratio. I got to give you at least 25. So let me make it 40. That should be enough. Let's take a look and see if we can get there in 40. Okay. Oh, no, it's not going to be enough. I'm assuming that we want to end up doing this back ratio for a neutral amount of money, so that if we end up running up, what you can end up seeing, yeah, we're going to be slow, aren't we? Okay, we don't want to end up losing money on this thing, so I'm going to have to even go further into the money. Let me go. Okay, I still have a debit. Just go to 90. I still have a debit. You know what? I'm gonna call that 0. So let me redraw this. Okay. So here's what ends up happening, right? This thing looks great, and what people do is they put it on the analyzer, and then they say, well, if we drop way down here, volatility is going to go up. So let me take a look at increasing my volatility. Okay, and so what I'll do is that I will end up, instead of looking at ranges, I'm going to take a look at vol steps going up 5, 10, 15, 20 points. And I look at what happens if we go down, and it's like, wow, what a great trade. This is the greatest thing. I can't believe everybody doesn't trade this. Here's the problem when you trade these in reality, okay, and you actually have experience running them through a bunch of different, real runs. Okay. Instead of taking a look at a vol, let me go back to the expiration chart, and actually let me do a day step. Okay. And this is in May, and there we go. So each line is 13 days. Okay. And I know people say, well, I'm not going to end up being in this for a long period of time. Okay. I'm going to end up being in this, okay, and I'm going to get out with a month left to go. So, I'm only going to lose this much money. The challenge is that you were right. We end up pulling back 4%, and you lost money. Okay. In addition to this, normally what will end up happening is that skew normally would hurt this trade, because what will end up happening is that the implied volatility of our long strike at 2290 will end up going up at a much greater percentage than our strike, than our long strikes at 22.10. So when I come and I take a look at the actual strikes here, this implied volatility is already at 15.8. If I take a look at the implied volatility here, we're at 13 and a half. So tell me how, if you buy twice as many high volatility options and you sell one low volatility options, where's your edge? Okay. Um, they look great on paper, like I said. And if you time it and you put in your position and you end up having a set of rules that end up working absolutely perfect in the back test, the challenge is that you're never going to get two exact same markets. And there's a very, very strong possibility that the way the volatility ends up moving and the vol skew changes, the fact that you started paying so much more in volatility when it's already jacked up a little bit, right? Everybody likes to put these things on when the volatility is high because that's when it's going to protect you. I just don't see them working very, very often. Um, can you end up getting them to end up working properly? Yeah, you can. I'd rather see you do something with the timing of this thing, meaning that I'd rather see you, either sell the front months and buy the back months, or buy the back months and do vice versa. Because what will end up happening is you can at least play off of the change in the term structure somewhat. Um, if volatility doesn't drop, okay, and if volatility is pretty low and vol skew is extremely flat, and you want to end up putting this on as a hedge, that's not a bad time to do it. But when we have an ultra steep put skew, like we've been having, and we have IVs already starting to move up a little bit, and the put skew not getting any flatter, okay, it is a terrible time to end up putting these on. And if you make some back test rule to say, well, I put these all the time, okay, with 65 days to go to expiration, and you're not taking into consideration, okay, your overall environment. I'd be very, very careful with them because there's a good chance, and I've seen this happen more times than not. The probabilities that I've seen more than 50% is that people put on these back spreads, the markets go down, they lose money on their underlying position, and they lose money on their back spread. Okay, so that's the reality of if you try to trade these any amount of time and you understand how the put skews work. I'm trying to look for any other questions because I told you I was going to end up giving you one other trade, and I was saving one of the questions about if I would put on an XIV trade right now, and that's the one that I'm saving for the end. This would be future volume. Does it make sense to take a look at S&P volume options? The problem with looking at volume of the options is that yes, it does, but you don't know if they're buying or selling, and you don't know if they're. You can find out later on if they're on puts or if they're on calls, but you have no way of knowing. You may see a very, very high put to call ratio, and if they were buying puts, that's definitely tells you something. But what happens if they're selling puts? What happens if they're selling put spreads? And they're selling just a ton of put spreads, which is a bullish trade, but you end up seeing a very high volume on the puts. So you really can't glean as much information from options volume. Okay, I'd be a little bit careful about that. There was one question, and I'm not going to go into tape reading, okay, but I am going to show you just one thing on here on the E-minis. Yep. And I'm going to take this to a 1 minute chart. Okay. And let's here. I just really want to look at today. Okay. So one of the things I want you to end up seeing here is that we've been having higher highs and higher lows. We definitely seem to have a range here where we came down and we didn't get lower than this. And so I would say, 20 to 23, 28. It's kind of an important line because if we end up breaking that, that's going to be the first one where we didn't make higher highs and higher lows since, after the first half hour of trading. Okay. And we did end up moving up during the first half hour of trading. And so you can end up seeing that now they ended up stopping it. And this is what I wanted to point out to you on pretty low volume. So it's not like the sellers really pushed the gas pedal here. It's kind of like they just took their foot off and said, okay, well, we're not going to sell anymore. That's not a good sign. Okay, that can be a bearish sign. If we do break through it and we break through it on volume, I'd worry about that. But every time you can see, every time we've gotten to low points here, the volume hasn't been that much. So it's the sellers aren't being real aggressive. Yeah, your up bars tend to end up being on bigger, volume bars. And so this tends to look to me like a bullish tape right now. But I would be very, very weary and watching when we end up having sell-offs. Okay, are the down bars happening on volume? Okay, if the down bars don't happen on volume, we're going to end up continuing to drift up the rest of the day. Vol will continue to come out. If you see what's happened to the VIX and the VIX futures, okay, during the day, you can end up seeing we've just continued to end up drifting down. Okay, and so these things it's saying that the sellers aren't all there. Okay, and so that was the question. I know we're over, but go ahead.
Could you take a second, go back to the ES chart? I want to just make a quick comment about the red bar.
Please, which one? Hang on, it's coming up right now.
You know,
do. Okay, there we are.
So remember, like I have my volume bar set to show the green or the red that's on the candle. So one of the problems is when it shows a red bar, especially when it's very narrow and there's not a lot of volume, you're not quite sure. There can be all buyers in there and a seller that drops the bar down so it looks red. There could have been 10 orders to buy and 1 order to sell, and the bar is red. The 10 orders to buy to me is bullish. But that 1 order to sell at the end of the bar that drove the bar down to make it red makes it look bearish. So you do have to kind of take that into account when you're looking at TOS.
Very, very true. A lot of times your tools, like for example, one of the things that reason why I told you not to look at volume on the options was because you don't know if they're buying or they're selling. But if you have detailed data, you know where the bid is, you know where the ask was, you know where the trade was executed, you have a good feeling that, if the trade was executed on the bid, right, at the lower price, that means that somebody wanted to sell it pretty badly, that they hit a bid. And so it was probably the market makers that bought it, and it was the investors, the money managers who wanted to end up selling it. And I don't want to get into it, but there are tools, and I do get a newsletter, institutional newsletter, that end up passing me that information. I'll end up reviewing that newsletter next week. Okay, we'll take that next week.
I just wanted to bring that up so everybody's aware that that's how that works. The other software that I showed before, they actually count the buys and sells to make the bars red or green.
Okay, and it's very, very important. It's very important. And in the option side, I'm going to end up showing this to you also. Okay, I was asked whether or not I would end up buying XIV. This is the graph, okay, that I use for VolVantage. Okay, if you guys were getting the VolVantage newsletter or subscription service while it was free, this is one of the graphs that I'd send out on a regular basis. It shows you my initial purchase when I ended up getting in back in late November. I ended up buying additional trading shares on January 30th. I also end up sending out an email on the 23rd of February that we were at a purchasing point. And what I've said many times is that when we get pullbacks, I will also dynamically change my trading rules. I'm willing to end up taking and giving it more room to breathe once I'm playing with the casino's money, so to speak. like up here, than I would over here. Over here, we were very, very close to stopping ourselves out. Okay, very, very close. Okay, over here, okay, when we had this much bigger sell-off, this was a buying opportunity. Why? Because of two things. One was where we were in our trade, but two is also the strength of the vol vantage indicators that I end up using. What ended up happening here as we ended up selling off was that only because we were getting so close to expiration, and remember, expiration was a couple days after this, it was right about here. Okay, we were getting so close to expiration that I dynamically end up changing my rules as we get closer to expiration, that I thought it was a lot more expiration noise. Well, we continue to end up having the Volvantage indicators deteriorate, and so I got out on Friday. I got out at an average price of 67.72. I got out in three stages. I sold the trading shares, half of the core shares, and half of the total shares. The problem was that I got out of my first shares at above 69, right? So it was a decent trade to end up getting out here. But then during that really hard sell-off that we had, we triggered stops that I had to get out of the whole position, and so I did at an average price of it. And so I was asked, is this a good time to end up getting back in? Let me end up showing you if I have. I think I said. Let me just make sure I made one modification. So I just need to end up saving my grid, and then I'll end up pulling up. Okay, let me pull up this XIV. Now, what happened in Vol Vantage is that we kind of got into no man's land. Okay, that we had this hard sell-off. Okay, and we're really not at a buying point for the XIV, but we're also not at a point where we should be going long the VIX and buying the VXX. So right now we're in cash. Going to stay in cash until we end up getting a signal, because the risk of something moving against me is too great, and the movement would probably be pretty harsh. So I am not going to end up putting on a trade. The Vol Vantage, okay, we'll send out an email during the week for anybody who does sign up for it, because at this point, I also wanted to finish the trade to give everybody the trades and let you know exactly where we were, close out the trade. So you got the first full trade through the free trial period, and I extended it actually even more than a full month. Going forward, you'll have to end up signing up. Anybody who ends up signing up, we will not actually start your subscription until the first day that I put on the next trade. So if that's next week, it'll start next week. If it's in 3 weeks, it'll start 3 weeks. So there's no need to end up waiting, okay, and saying, well, I'm going to wait till the trade goes on, because we won't start to bill you until that first trade goes on, okay? And that will end up being up probably by tomorrow or Wednesday. You'll be able to end up signing up for it. So I was asked, well, what trade would I put on? Let me show you what trade I did put on in my trading account, not in the trading account I show you, but in an IRA account that I end up also keeping. What I was looking at in this particular graph was that if we bounce back up, if volatility ends up getting lower, and the VIX goes back to normal, and we get the contango push goes back to normal, this thing can end up moving up and moving up pretty quickly. Okay. However, if we continue to get the market to sell off and the VIX goes higher, and there's a lot of room for the VIX to move higher. You know, we're talking about how the VIX is at a high point, and it's at 13.7. I mean, give me a break. I mean, it's historically 13.7 is really, really low, and we haven't even started to sell off. What happens if we start to sell off and then it does end up jumping significantly? Well, if something like that happens, you get a movement, and let me highlight this. This is kind of what happens to the VXX, right? It goes from 47 to 23 in a couple of days, okay? And the exact opposite thing would end up happening in VXX, right? And it's, right, you can't even tell where that little bump was here. I happen to know where it was, so let me just highlight it. Okay, and you can see here the VXX went from 50 to I'm not in the right place. I'm in the previous year. That's why. This is what I wanted to show you. Okay. You end up going from 62 up to 125. Well, if I don't count this little piece right here. And so I take a look at it. Did I need to be in it just 4 days? No, I could have gotten into it a little bit later. What did? And this one is this one's just pure, in my opinion, just pure gambling. Okay, take a look at what happened to the UVXY. Now, again, if your timing is perfect, you went from 640 up to 1600, right? You went up 150%, and then you even went up high. Now, you're never going to get the timing absolutely perfect, but what do you end up putting on in a trade like this? What ends up happening is that once you start to end up moving up, the calls get to be very expensive. I mean, they're very expensive all the time, but the way out of the money stuff gets to be uber expensive. So the trade that I put on was the following. I bought the 18. Okay, if you remember where we started, we were just about at 18 on the UVX. You can see it right here. We're at 19 now. We're up 0.8 on the day. And I sold at 25 and I paid $1 for it. Okay, I did this on Friday. Because I said when we were having some calm, I'm like, you know what? The chances of this blowing up, meaning that the market's selling off and us going not doubling or tripling. I'm just saying you go from 19 up to 25. Okay, it goes up 30%. Okay, it's any type of harsh day or two sell-off would get us there. So what I decided to end up doing was buying the vertical. So I bought a 7-point vertical for $1. And so you can see I did it 25 times. So if I did this, let me just show you once so it's easier. Okay. If I did this one time, I risked $101. That's what I paid to end up making $600. Right? So I had a ratio of risk 1 to make 6. I thought there was a equal likelihood that things either get better or get worse. If they get worse, as we talked about, it's probably going to get significantly worse. And so what I ended up doing was I took a look and I did some math behind it. I took a look at the options and I tried to end up getting as much money as I could for the 25s. And I don't know if I can show you the time that they were executed. Okay, the verticals. I bought a couple of the verticals earlier in the morning before things got to be terrible. And when we closed the day, okay, and if I end up actually here, let me flip this, do this way, not high trades, but show you the actual. You can end up seeing here that I was up a little bit on the day, right? I was up, maybe $100. We sold off this morning, and it's up $1,000 on the day. Do I like this trade now? Well, I like it because I'm going to keep it on. So the answer is yes. Would I end up keeping it and continuing to end up making it work from here? I'd probably move it up a little bit. I'd probably use the 19 and I do an assessment. But, I like the concept of risking 1 to make 5. Okay, 1 to make 6 in my case. If I was going to end up playing any type of movement in any of the vol vantage type of arena, and it's not a vol vantage trade, but anything that uses VIX-based ETFs, VIX options, this is the type of trade that I would end up putting on it. Okay, and I did put on it. Okay, any questions? Okay, I don't see anything else. Paul, do you see any other questions?
Nope. I think we're all set.
Okay. So what I'm going to end up doing, guys, is I'm going to end up stopping the recording now. Thank you very much. And send me an email if you have any questions. And what I'll end up doing, what Paul and I will end up doing together, Paul, I just volunteered you. I hope you don't mind, is that we're going to end up taking a look at one of the institutional newsletters that are only sent out to institutional brokers. We'll take a look at one next week because it will end up showing you not only how to end up reading, and they do this for you, right? And they send us, here's the volume on the options, here are the individual trades, here's where we ended up seeing, heavy buying pressure or heavy selling pressure by some type of an institutional investor. And we'll end up going through them, and we'll end up picking out one of them that we'll end up working on together. Okay? And so with that, guys, thanks very much, and I'll talk to you next week. Thanks, Paul.
See ya.